Mortgage rates are plunging, but does refinancing actually make sense for you? In this video, I'll walk you through the 3 steps every homeowner should take to know if refinancing is actually worth it. My name's Darren. I'm a mortgage broker here in Southern California, and my channel is dedicated to people just like you build wealth through real estate. So if you're a homeowner, you've probably seen the headlines, mortgage rates have dropped. But let's break down what that means for you. So first, let's take a look at what's happening with mortgage interest rates. So if you look at this chart, you're gonna see a pretty sharp dip in mortgage rates right now. And what this means is you probably have a small window to potentially refinance. So this chart actually shows the average interest rate for 30-year fixed mortgages over the last 18 months. So as you can see from the chart, mortgage interest rates were at their lowest last September of 2024. And now about a year later, they're at the lowest they've been in the last 12 months. And so the real question you should be asking is, does it actually make sense to refinance or pull equity out of your home? And to help answer that question, we're gonna go through 3 steps. And so the first step is gonna be check what your current mortgage interest rate is, and then go ahead and compare that to what is available now. Second step, this is more so if you're looking to pull cash out or you tap into your equity, but check out the equity in your home. And the third step is to run a break-even test. All right, let's dive a little bit deeper into step number 1. Check your current rate and compare it to what's available. So if you don't know your current mortgage interest rate, that's totally cool. Go ahead and pull up your mortgage statement. It's gonna tell you right there what your current interest rate is. So after you know your current mortgage interest rate, go ahead and go to Google, type in average 30-year fixed mortgage, and then the mortgage type. So if you have a conventional loan, put conventional. If you have an FHA loan, put in FHA. From there, it's gonna pop up, something similar like this. After you've done that step, and go ahead and compare those 2 rates. Now, if your interest rate is 0.5% higher than the current average, then you should probably consider looking at doing a refinance. And doing a simple rate and term refinance could be saving you hundreds of dollars a month. And if you're not sure what a refinance is, or some common reasons why people refinance, that's totally cool, totally fine. I actually made another video detailing the most common scenarios and when it makes sense for people to refinance. So if you're completely lost, you don't know what I'm talking about, go check that video out. But big takeaway from step number 1, look at your current rate, compare it to what's available. If your rate is 0.5% higher, then maybe consider doing a refinance. And now that leads me to step number 2, evaluate your equity. So if you don't know what equity is, it is simply the value of your home minus your current mortgage balance. Here's a quick example, right? If your home value is $750,000 and your current mortgage balance is $250,000, then your equity is $500,000. If that's your exact scenario, congratulations, you have a great amount of equity. And once again, you might be thinking, Darren, what are you talking about? I don't really know my home value. I sometimes look on Zillow, I sometimes look on Redfin. I don't really know what it is. If you want a free home value report, you can use this software called My Home IQ, something that I pay for. I let all my clients use it for free. It sends them a monthly estimated value report, and it will show you your current estimated equity as well. So once again, it's a free software for you. I pay for it. My clients love it. All you need to do to get a report is go down below, use the link, put in your email, name, and address. And keep in mind, step number 2, figuring out your equity is more so if you're thinking about doing a cash out refinance or tapping into the equity of your home, maybe using a HELOC or a HELOAN. You will also need to know the estimated value of your home for a regular rate and term refinance just to lower your monthly payments. And now that you've gone through step 1 and 2, the third step, which is very important, is running a break-even test. So running this break-even test will basically tell you if it's worth it or not to refinance. And so every refinance will have closing costs. And these closing costs are going to be made up of things like title, escrow, lender fees, prepaid interest, insurance, property taxes, and these closing costs are going to vary. So if any lender tells you there's a free refinance, please run away as soon as possible because they're lying to you. Every refinance has costs. And so it's super important to run this break-even test because it will tell you how long does it take for the monthly savings on your new mortgage payment to equal the cost of the refinance. And I'm going to just walk you through imaginary numbers, right? These are educational numbers. If your closing costs are $6,000 for your refinance, and you're going to be saving $200 a month on your new monthly payment, it's going to take you about 30 months to recover that $6,000. And so after 2.5 years of that new payment, you will finally have recovered that $6,000 in closing costs. And then after that, everything is truly savings. And many people like to use 3 years or less as the break-even time to consider a refinance a good refinance. But in reality, it's 100% dependent on you and your family's long-term financial goals. So only you and your family know if you plan on staying in that house for another 5 or 10 years. So in this example, right, if it takes you 2.5 years to recover your closing costs, but you're going to sell the house in 1.5 years, this refinance doesn't make sense at all. So the main thing to consider with this break-even test is the shorter the amount of time to recover the closing costs, the better. And I'm going to walk you through a real life example of one of my recent clients. So my client had a $1.1 million loan at a 6.625% interest rate. With the recent drop in interest rates, we were able to refinance them down to a 5.585%. And so their cash to close, their closing cost that they had to pay was about $1,200. And their monthly savings is about $760 a month. So their break-even point would be about 2 months. So after 2 months of making their new mortgage payments, everything after that is savings. So in the first year, they're going to be saving about $9,000. So in this scenario, it was a no-brainer. Super short break-even time. And so going back to what I said before, a lot of lenders will tell you, oh, you can get a free refinance, it'll be no cost. But the reality is there's going to be closing costs no matter what. Now, the difference is that you can take a slightly higher interest rate and get a lender credit. So the lender credit will actually cover the majority of the closing costs. So same thing with these specific clients, they probably could have gotten a lower interest rate. So their cash to close would have been higher and their break-even period would have been higher. So we found kind of the perfect blend of, monthly savings, a super short break-even point, and monthly savings that made sense for them in the long term. So just to reiterate the 3 steps that you need to take if you're thinking about refinancing. The first is check your current rate and compare it to what's available now. The second one, evaluate and figure out what your equity is. The third is if you decide to move forward, go ahead and figure out that break-even point. And if you're feeling overwhelmed or you don't know about your specific scenario, feel free to email me at darren@realdarrensci.com, or you can text me at 714-887-5432. If you decide to reach out, it'll be a no pressure conversation. We'll just take a look at you and your family scenario and figure out what's best. As always, I hope this video was helpful for you, and I'll see you on the next one.